So we've got a bond expert here as well, Andy Brenner. Andy, please jump in. These were significant hurdles to get through that we saw the market improving after it was a better than feared auction. But what are your big takeaways?
Well, Rick, good to see you again. First of all, the bond volatility really scares me. It's up above 51, and I really don't think that, and I see the dollar selling off as well. And the fact that the long bond spiked to 502 the other night in Japanese time really bothers me. And I do fear the same thing that Rick fears, that we haven't seen the worst in treasuries as of yet.
So those who look at this and say, okay, we might have a slowing economy, we still have these recession calls Steve was alluding to. It's not a time to jump in and buy bonds at these levels here?
Well, I think the absolute levels are fine, but I just don't think the momentum is there for you. I mean, when you look, as Rick just said, 230s has gone from 50 basis points to over 100. I mean, it's, the people
Isn't that
are
usually
looking
bullish? I mean, when things steepen like that, we're supposed to say, hey, that's a sign of an expanding economy 6, 12, 18 months from now.
Yeah, but there's just way too much uncertainty. You don't know what the next shoe to drop is on tariffs. You know that there are a lot of countries that are very upset with the U.S. right now because of the way things are, and they could stay away from auctions. I just think the volatility and the uncertainty are going to make things really tough for the next 3 to 6 weeks.
We have the MOVE index up in the back that we could do. I've got it at 124, up from 90.
That's the bond market volatility.
That's bond market volatility.
Totally.
And you were citing
numbers.
the VIX earlier, which is the stock market volatility. Yeah. Both are highly elevated. Yesterday, the 210 spread moved in a 2 standard deviation move. It was like 6 or 7 is a big day. It was a 14-point move yesterday in the 210.
Right, and I'm joking to some extent about the steepening curve, but you don't want the long end blowing out ever. I mean, unless you anticipate that there's a growth boom around the corner. Otherwise, your only options are over deficit concerns or over inflation.
The stock market's over at the kids' table. The bond market's supposed to be at the adult table. And when you see that kind of volatility, look, let's not create concern where concern shouldn't exist.
But is it notable that it hasn't calmed down dramatically today, right? If the whole point yesterday was that the president, to some extent, maybe a small extent, but to some extent was responding to the bond market volatility, reversed course, and then a day later, we're still at these elevated readings. What does that tell you?
What tells me is when I look, and we have Erica coming up here, when I look at what didn't happen yesterday, when I look at the way that the economic forecasters reacted, it was a whole lot of nothing. I think one way to think about this, I think the market wants a full apology from the president, not one of those, I'm sorry if you feel hurt, right? And if you look at the average tariff rate, we were at 3, we went to 30, and now we're back to 25, depending upon what you do with China. It could be as low as 18. But then you get rid of China trade, which is not a good economic development.
Erica York is standing by, Michael Gapin as well. And Erica, I don't know if you guys have been trying to tally up the numbers, but what are we talking about in terms of economic impact, in terms of revenue that would even be collected under these scenarios at this point?
It's still really significant. We were actually about ready to publish our updates, and then the White House clarified the tariff rate on China is 145% instead of 125%. So we're working the numbers, but like Steve said, this is still a significant increase in tariffs. When the dust settles, we're left with 145% on China, 10% on our major trading partners, excluding just certain types of energy-related imports, and 25% on autos, auto parts, steel, aluminum. So this is still a generationally large tax increase. And we estimate it'll be something like $170 billion tax increase in 2025. It'll take the average tariff rate still to highs that we haven't seen since the 1940s. So this is major. It's huge cost increases. It's an economic hit. It's clearly not setting us on a very good path. And still, we're
on an apples to apples
next tariff on in 90 days. It's not like the threat went away entirely.
For sure, Eric. I was just going to say. So remember when you were on a week or so ago, and I believe the estimate was 280 billion was about the you call it revenue tax. Just make sure we're talking about the same pie here. The amount of money that would be raised by the tariffs under the reciprocal regime. Under this new regime, you think that falls to about 170? Is that right?
It falls off largely because at 145%, most imports from China, we estimate, don't come in. So it really cuts off trade from China. So you don't get a lot of revenue from 145% tariff there. We estimate the 10% tariffs on the rest of the world, still rising later in the year as scheduled, will altogether bring in $170 billion. So significant tax increase. Clearly, it's difficult to model a plan when it seems like there really isn't a plan. We, in the past couple of days, saw the Trump administration wasn't clear on the tariff rates we were charging to our three largest trading partners, China, Mexico, and Canada. Those have all been in fluctuation. Yes. So a lot of uncertainty.